everybody, Craig Moser. Hope you're having a good May. It seems to be going faster and faster every year, but wanted to spend some time with you and show you what I'm seeing in the market. In general, we're seeing in the stock markets a sideways churn. It seems like the markets get good news one day, bad news the next. What my opinion, again, opinion only, is that we're seeing a lot of money move to cash. Why? Because people are afraid. You're hearing the word recession a lot. That typically gets people remembering 2008. I don't think we're going to see a 2008, but we'll see what happens in the future. As we work towards Q3, I guess some of the things that we'll see there will be just trying to decide if the interest rate hikes have actually slowed the economy down enough without being too much. Are we in the Goldilocks stage, or did we do too much or too little? We'll find out. And as you see unemployment maybe drift up a little bit, depending on which side of the fence you're on, that could be a good thing or a bad thing. But nonetheless, that's what the goal is, to slow it down a bit and to have more people that should working for a reasonable wage, so that the employer cannot charge higher and higher, progressively higher rates on the food and commodities that they sell. All right. So anyway, let's take a look at what's up first here. Hang on a second. Let me get to my handy dandy chart system, because you know I'm going to do charts. We look, first of all, just up here, I have the bond aggregate. So this red and green changing thing right here, that is the daily pricing, and I happen to be on a 2-year chart here. So we're looking in the rear view mirror, and we're looking back 2 years. So bonds, if you use the iShares US Aggregate Bond Index, which is what I'm calling it used to be Lehman Brothers Bond Aggregate, not anymore. It was up around 116.50. Today it's 99.97, having come off of a bottom, which was about 93 and change. So giving you an idea of what's happened to the bond market in the last 2-ish years, is that the prices have gone down as we have seen interest rates go up. There's nothing wrong with the bonds. They'll mature for the vast majority of them at full face value. But if they are longer maturity bonds that have a while to go and they have a lower coupon, which means they pay a lower interest rate, well, guess what? They're going to price down, because you can get higher interest rates now. That's a good thing if you have new money to put in bonds. And then the typical yield, now this is trailing, is about 2.83 on that bond market, because it has bond maturities all over the place. So does that mean you should buy bonds? Maybe. We've been buying bonds. So we've been buying bonds all in this window right here, and still are, to try to get us to have a stable floor, something that pays at or close to 5%. It's great to have some yield back. All right, let's look down my list of stuff that I have here. So oil, interesting on oil. So oil came off of a pretty significant bottom back during the Trump era. I mean, if you go back 5 years, it looks a little more profound. Down in here, oil hit very, very low prices. This was back in mid to early 2020. So prices dropped like a stone. It was very, very, very low. And then prices have gone back up as OPEC and what have you have decided to charge more for their barrel of oil. There's plenty of supply and there's plenty of demand. And so they are in control mode, deciding what and when they should do with a barrel of oil. There's a lot of stuff swirling around in the world about reserve currencies and what have you. But for the vast majority of stuff out there, the US dollar is still the reserve currency, and so most of it trades that way. Now, this isn't the actual price per barrel, but this is the closest I'm going to be able to get to showing you the way that oil has been trading over the last little while. So just take a look at that, and you can see that oil is trending down, maybe back to as far as where we were back in, I don't know, 2021. All right. Next up would probably be gold, if I Yep, I had gold there. So gold for the last 2 years has moved up substantially, been higher. It was higher right here during 2022. I can't remember why it was up that high, but it was. I think when people get afraid, they tend to start looking at this because they think they might need it as a currency. You know, the same thing perhaps with Bitcoin or some of the other cryptos. It's an alternative to a dollar. It's an alternative to a currency. So it's up right now, but it has been trading up and down really since right in here. It made its run, stopped about the 3rd of last month, and now we're sort of getting the churn. It does that a lot. And the markets, you're probably going to see more of that moving forward. Again, no yield. You're just buying a piece of very nice yellow metal. So that's what it is. Okay. Looking at the international world. So this is not us. The United States is not in this index. This is the more developed countries. So you're looking at Great Britain, Spain, France, Germany, Australia, Japan, Canada in this EAFE index. EFE is Europe, Australia, and the Far East. So good countries in here, just not the US. And so you can see took a pretty significant dropped until about October of 2022, and has had a fairly strong rally. So developed, let's just call it Europe to make it easy, has done pretty darn good in 2023. So it's ramped up some, and it made its bounce right around the end of October, the beginning of November of last year. So we'll see how it does. As most everything else does, and during this time of year, we start getting the sideways churn as people don't pay as much attention. All right. Let's look at emerging markets. So the 3 biggies are in here, Russia, India, China. There's tons of other countries in here, but those are the 3 sort of biggies. So you can see it's been a while since that index has seen daylight. So part of it's Russia, of course. You know, uncertainty about what's happening with China makes people maybe not buy their stocks as much. And so these are things that as you look at indexes, obviously when people are not comfortable putting their money there, this is what happens. Declines in the values of those stocks. Will this happen forever? Doubt it. So is this something to keep an eye on? Sure it is. All right. All right, let's look at the Standard & Poor's 500 index, because a lot of you are getting 1-year trailing numbers and it's showing that it's about even, and it is. If you go back to about a year ago, it'll be somewhere right in here, and we're pretty much at even. But if you go back to the 1st of 2022 and measure, we're not even. So we're down 13 or 14%. I can't get it right on there, but you can see we're right over here at about 41.06 right now, 41.22 in that range. And that's kind of where it's starting to levitate at. And if you look a little further on, you can see back in time that this area right here seems to be sort of a top. And this area right in here, for a lot of times, seems to be when it sort of stops going down. Not all the time. There's nothing perfect in a chart, but you can see that we're starting to do this sideways little churn thing here, which means that nobody knows what to do, in my opinion. All right. So as we look through, that's the biggest part of the world. So, I mean, we could look at real estate, I guess. So there's a real estate ETF that we can use, Fidelity, and you can see the price of real estate, if we're using REITs as our investment choice, has declined steadily since right here, which was the 1st of 2022. So again, we're seeing this progressive sell-off, nothing horrific, but the trend is not your friend right now. So looking at this and saying, I'm going to try to pick a bottom, or saying that, hey, maybe the real estate market's going to rally, it's just a guess. Nobody knows at this point. It's better to play safe. So safe are things like this. Don't laugh. If we hit BIL and put that in there, the price doesn't vary. 91.84 to 91.35. So the price is pretty stable. You pick up a 2.77% yield. That's 1 to 3 month US Treasury bills. About the safest thing we can put our money in. And if you compare that to something like the S&P 500, you can see, you know, that, there you go. Bill is this guy in the middle, and this is the S&P 500. So it's funny, we would have ended up about the same place just using something that would be a cash equivalent. All right, guys. So as far as panic is concerned, don't. You know, we've got most of our portfolios in a more safe position for the time being, not certain what's going to happen. Why take the risk? We're focused more on income. So we're putting bond portfolios together that'll get you close to the 5% range. We're using structured notes to kick that up a little bit. So you're getting returns in your fixed income piece of about 7.5 all in. Anyway, make it a good rest of May. If you need us, our number is 336-448-1086. Happy to talk to you if you need a second opinion, if you're a little concerned about something, or if you just want to talk about something, be happy to give you some time and hopefully get to know you a little bit. Make it a great rest of the month.